You're 90 days from loan maturity. Your lender ghosted, your limited partners want out, and you're sitting on a $100 million asset and about to lose it. What do you do? Very simple. You call David Eisenberg. He's restructured over $1 billion in capital stacks. He's the guy that the top real estate operators call when everything's on fire. And today, he's pulling back the curtain on how real estate empires get saved. I'm Jerry Katz. I'm the founder of Premier Protection Insurance and the host of Real Estate Profit Boost, where we teach you everything about building wealth in real estate, but real strategy. So with that being said, David, welcome. So we're going to roll right into some of the strategies and everything that I just said. So David, I want you to start us off strong and tell us about the craziest deal that you've ever saved. A real scenario where someone was on the verge of a massive default and you pulled them out.
I'll give you an interesting one because it definitely was a first for me. So there was a project that was built in Port Orange in Florida, so it's a little bit northeast of Orlando. Mm-hmm. Two local developers built it from Miami, substantial guys, and their limited partner was a group out of Singapore, so offshore LP money. When they first financed the deal, they had gotten the debt from a debt fund, and back then, 700 over seemed really good because the over was zero, right? But then we were going through that period of time when SOFR was beginning to kick up, and all of a sudden, when the loan was delivered, when the property was delivered to TCO, and the construction loan was supposed to roll into a mini perm, when it was like 7-8% money seemed okay, and when it became 12% money, not okay. And what winds up happening is the developers, the general partners, generally have to make a decision. What do we do, right? Because this was a scenario that a lot of people were dealing with. We blew through the interest reserve, and we personally put up completion guarantees, which usually have interest and carry guarantees.
Got it.
So their view was that it was time to sell.
Wow.
Now, what happens, not often, but certain, enough times where the motivation of the general partner does not align with the motivations of the limited partner, because from the limited partner standpoint, their view was that if you went through the lease-up process, that you will be able to extract substantial value from the asset. So they would be leaving a lot of money on the table if they sold early. From the general partner standpoint, that's fine because they get off the guarantees and they still make profit and enough return for them. So
interest rate reserves are gone, everything. So the GP, he sees equity, right, after the lease up, but there's not enough, right? All the money's gone, right? So GP wants to stay, LP wants out.
Right. And the general partner usually puts up the guarantees for a deal, whether it's, even if it's non-recourse, you still have completion and construction, carry interest. And post TCO, if the interest rate is higher than we assumed, then you blew through interest reserve. It's somebody has to write stroking checks.
Right, exactly. Got it.
Big numbers. So the limited partner had another challenge in that they were an offshore entity. So they themselves could not put up any of the guarantees necessary to refinance. So even if I was able to refinance, they themselves would not be able to be the sole borrower. So we had to solve for a couple of things. Interest rates are going up, so a straight refinancing could not take out the existing first mortgage. It needed something extra, and we'll get to all those different extras out there. And on top of that, it also needed some balance sheet support from a local sponsor in the U.S. that can prop up the bad boy carve-outs, the interest carry, and what have you.
Got it.
A tall order, because usually the providers of capital, passive capital price, so MEZ, PREF, are not the ones that are putting up the guarantees. So very challenging to find.
Got it.
We looked into our universe, and we also ascertained that this deal is not something that is going to be widely marketed because we were seeking such a very specific nuance. And so the type of provider that we needed was one that was willing to do subordinate capital, because you need to go higher in a stack, so it needed to be mezzanine or preferred equity provider, because a normal senior loan would not be enough to take out the construction loan. And they also have to have some sort of principal operation so that the other side of the house can provide that guarantee. So we
Understood.
identified, I'm going from memory, maybe 4 or 5 groups that we thought fit that bill. So the limited partner initiated a buyout of the general partner.
Got it.
So the uses of funds in a buyout was to pay off the existing construction loan,
Right.
pay off the general partner. So it was quasi cash out, at least for the general partner, and then to fund reserves necessary to complete the lease up of the property. Because the
Right.
view was at that time that when we complete lease up, there could be, the property would go from 70 million to $90 million. So there was, significant
Understood. Right.
value of lease up.
Right. I'm
Uh,
just clarifying because we have an audience that's across the board. But then the limited partner that initiated the buyout is a foreign entity, right?
Correct.
And they
And
wanted to use leverage, and they can't do it because it's a foreign national. Very difficult to get lenders. Understood. So now you're bringing in another group that can support the loan, be local, do the whole personal financial statements, the guarantees, and
correct.
everything of that nature. Okay. Very complicated situation. Not easy.
It
Understood.
it was definitely a new one for us.
Right.
So we did identify several groups that sort of fit the mold for what we were looking for, and one of them knew the market fairly well. So we engaged in a complicated negotiation for them to provide preferred equity, but also for the what we call the other side of the house. So the principals of the house also have a ownership entity that owns 20, 30,000 units. We
Got it.
needed them to provide the guarantees on the loans. They would de facto become the general partner of the deal. There are some conflicts between a preferred equity provider also being the general partner. So those are things that we had to work through. And I don't want to go into a deep rabbit hole. When the money comes from a fund, you can't segregate capital into deal and a senior subordinate. It has to be sort of the same. So we wound up structuring what I coined as a unitranche preferred equity deal. So it was the first for me, after 30 years. I've done
Hmm.
unitranche debt, but never unitranche preferred equity deals. So that one portion represented the preferred equity, which was passive going into the deal, and the other represented the return for putting up the bad boy guarantees and the recourse.
Got it.
And that opened up the universe of debt providers for us. So instead of going with a debt fund, we wound up going with a local bank. And the sponsor even put up some deposit money with that bank that they had a relationship with in order to get a better rate. So, pretty complicated transaction, but the general partner was happy because they got out of the deal that they wanted out of. And the limited partner, got the chance to um,
Finish the
recognize
deal.
gain as
Yeah.
it happens into the marketplace.
So the general partner got out flat to whole with some equity, with
No,
some
yeah, no,
upside
they got out as they wanted
as they wanted at the current valuation or whatever it
at the time.
was.
Correct.
Gotcha. How did it all turn out? The deal finally stabilized? Yeah.
Well, funny you should ask.
Yeah.
It did stabilize. It was the right bet to make at the market at the time, but the market did get a lot of deliveries, into the space, and so the maximum value has not yet materialized, and we're
Got
going
it.
through another iteration of a recapitalization there now because the property's not stabilized. So we want to replace floating rate debt with fixed rate debt and convert the preferred equity into common equity because now is sort of the time based on the life cycle of the deal.
All right. So, David, what's the biggest mistake most operators make in that moment when the clock's ticking?
Sure. Usually they all suffer from paralysis analysis. In real estate, I think of it as the game of hurry up and wait. Um, you know, there's a rush to get options. You get out to market, go, go, go. And then sometimes it's almost too many options, right? Depending on the liquidity for a specific situation. And then they sort of pause and not know a next step, right? Or try and structure through too many things. I think of it as picking up pennies, right? Sort of, and
Got it.
crossing over the dollars. And that's been a challenge at times. We're just, like, here's what you need, and they're still searching for something else.
Right. And again, that's why it's important to have somebody like you on the team, right? Because then there's no analysis paralysis, there's no scrambling of lenders, shopping rates,
No,
all the above, right?
I've
And when you have a trusted advisor on the team, David has the answers. So I 100% understand that. And so most people won't get this kind of inside access to elite operators. Don't be most people. Smash that like button, subscribe, and send this to the smartest investor you know or the beginner who's a rookie. That's why we created Real Estate Profit Boost. All right, so moving on a little bit. Tell me a little bit about the capital stack explained. Let's define like what most investors still don't understand. So what exactly is a capital stack and why is it so crucial to restructuring deals, wealth and real estate success?
Sure.
I know that's a broad question.
It's a very broad question, and it changes, right, depending on, time and such. But I think of the capital stack as just a continuum of money that equals to the value of the property, and it truncates the ownership of different aspects of the deal. So, most people are familiar with sort of what I think of as the two bookends, debt and equity, right? And then that's sort of where the universe started. So you need a first mortgage, great. You go to bank, you go to insurance company, you go to credit union, you go debt fund, done, and then you come in with equity. And then we realized that, well, there's stuff in between, right? That's what they call gap equity sometimes, or subordinate capital. So that would be mezzanine financing or preferred equity. And whereas a senior loan is secured by a mortgage on the asset, mezzanine is secured by the partnership interest of the borrowing entity. So it's like a corporate loan. And then preferred equity, which economically functions very much like mezz. There's just, again, a lot of nuances why you would use mezz versus pref, but preferred equity is just a senior equity slice in the ownership stack. So it's evidenced by an operating agreement. And that's usually where most people are familiar with, especially if they're doing larger institutional quality deals. But there's also gap capital, which is senior. So whereas subordinate gap capital means it's subordinate to the senior loan, that's mezz and pref, you actually have senior gap capital, which is it primes the senior loan, and that would be CPACE, right, which is commercial properties as clean energy, or ground.
Right, and that's my next question for you.
Or ground leases.
Because most people don't even know what CPACE is. Right, so explain it kind of like you're talking to a 20-year-old in college.
Okay. So, and CPACE, and I was going to talk about ground leases also, but CPACE is what I would call the newer or newest capital structure. Really became much more prevalent on the commercial side, I would say 7-8 years ago. It was, emerging on the residential side also, but in a very sort of short soundbite, it functions like assessment financing. So it provides for a mechanism to get 100% leverage on costs that qualify. And what does that mean by qualify? It means that those that generally touch some sort of energy efficiency, renewability, water conservation. So anything, and it doesn't have to be in a office, it could be a multifamily. The asset class kind of doesn't matter, but it has to touch some sort of energy efficiency. And then these are all administered at the municipal level, but they're implemented at the state level. So you can literally go state to state, and they have all different programs. So it's a complicated, process, right? And not a complicated process, but it's a complicated landscape of variation on it. But a good rule of thumb is if you're doing a new development deal, CPACE can finance up to 30% of the total development budget. That's like a good rule of thumb.
Wow.
And then it just varies. Now, it does have an impact on your senior financing because the payments that mimic a mortgage prime the senior lender, right? But it doesn't really function like credit in the standpoint of there's no acceleration. So let's say you borrow 20 million. I'll make it up. Let's say you borrow $20 million, and your annual payment is $1 million. That $1 million every year primes the senior lender. But if you default, you can't accelerate it because these are done as tax assessments, and you cannot be held responsible for taxes that are not yet due. So it's a weird hybrid creature. Doesn't really smell like credit. It has its place in the market in certain situations. So it's like a delevering of an A note that's expensive, or where we found it to be very useful is in a couple of situations where you're dealing with assets that are a little bit more volatile. So let's say hotels, for example.
Got it.
There are things you can do retroactive funding. So let's say you did the work 2 or 3 years prior, and now you need money to fund operating reserves or cap reserves or whatever it is. You can actually go back and retroactively finance out the improvements that you did prior. So it's sort of like getting found money for a transaction.
Okay, so for example, if I'm building a brand new ground up construction hotel, it's a $20 million deal. The senior debt is 15 million, right? That now the CPACE comes in for 5 million on top of that, and that's
I,
100%
I, I,
finance
I wish,
capital
and
stack.
sadly, that is how many people think about it, but that's just not the case because
Okay,
depending on how technical you want to get, CPACE needs to be serviced, meaning you have to pay payments as if it was a mortgage or mezz, so they're payments.
got it.
Okay, the CPACE payments are considered above the line, meaning NOI. So just like insurance reduces my NOI, CPACE payments actually reduce your NOI, just like a ground lease. And so it effectively leaves less NOI to service the senior lender. And so whereas in your example with the 75% leverage, which would be amazing to get for a hotel today, but let's make believe that
Right.
was the case, that was predicated on you having X amount of NOI once it's completed. But because of the CPACE, you now have X takeaway that amount. And so you cannot service that same 75%. So in the aggregate, you should be able to pull out a little bit more in leverage, but it's not a 1-for-1 leverage. Um,
Understood. Are they typically financed side by side?
they have to be.
They have to be. Okay, right. Because right, there's got to be enough NOI to service both sides.
Correct. But what's interesting is I've seen some hotel deals with historical tax credits, or even just a renovation of a hotel that's not leveraged. Not every.
Right.
I know people are shocked to find out, but not everybody has a mortgage, right? And so, if you need to do some work on a project, and this is interesting for those that don't have any leverage, if you need to do some sort of renovation work, HVAC, insulation, things that affect the energy efficiency of the building, you really have three options: put cash, okay,
Interesting.
go borrow money, okay, recourse from a bank, deposit, brain damage, whatever, or you
Right.
can actually get a CPACE loan. And what's interesting with a CPACE loan for an unlevered asset, it's probably better because it's non-recourse, it's long dated self-amortizing, and when you have an inverted yield curve like you do today, meaning short-term rates are higher than long-term rates, it's actually
Hmm.
cheaper than probably borrowing from a bank. So you lock in long-term financing that's self-amortized, that's non-recourse, and you don't have to deal with the brain damage of dealing with it later.
What about typical rates and terms?
I don't know, 300 over the 10-year treasury, so 7%, 8%. Still pretty
Gotcha.
good. Still pretty good for renovation dollars because if you go to bank and you borrow at 250 over SOFR, you're in the same range. So
Right.
you're really not getting that much worse off, but you're getting a lot of structural benefits.
Got it. And so is it very common in your world, right, to constantly restructure debt every 2 to 3 years? And, because most people don't think this way, right?
Yeah.
Syndicator's buying a 300 unit value add, whatever he's doing. He's got a Fannie Freddie, it's fixed rate,
Right.
or it's a bridge, right? And then they do it. But what I'm hearing is it's multiple restructures, right, of the capital stack, whether equity,
So
preferred equity. That's very common in your world. And what type of lenders allow this to happen, without, yield maintenance and all that good stuff, right? And massive prepays. And obviously, the fees could eat you up on closings and refinancing. And is there any tricks to that
yes,
going into the deal? Yeah,
every
right.
yes, the answer is
Everything, right.
there is definitely something to everything. So I'll take a step back and answer your question a little bit more broadly. That the capital structure needs to match the business structure or the business strategy of the deal, and a deal can sort of can sit in one of four places in its cycle. It can be pre-development, it can be development, it can be transitional, or it can be stabilized. A lot of people think of financing as a form of stabilization. I bought a building, I'm going to move the rents a little bit, maybe I'll do a renovation once in a while, but I'm going to put 5-year, 10-year money. I'm not going to think about it. There's
Right.
none of this going on, right, at the asset level. When you're doing a deal that is in the earlier stage of pre-development, development, or transitional, you are going through a life cycle which is anywhere from 1 to 3 years per portion, right? I bought land, maybe 18 months to get entitlements. I go vertical. Maybe it takes me 2 years to finish construction. Maybe it takes me 2 years to do lease up, and then I'm stabilized for 10 years or 5 years or whatever it is, right? So
Got it.
on the outside, long-term financing, you're not churning, right? Sometimes you might, if you have a real tick in value or interest rate drop, and then there are things like supplementals for Fannie and Freddie or Mez later on. But you are changing capital structure every probably 2 years as you take a deal through the pre-dev to the stabilization. Um, are there fees involved? Yes. Are there ways to minimize it? Partially. So one of the, you have transactional frictional fees like origination fees, transfer fees, recordation fees, and such.
Hmm.
There's ways to minimize it depending on what municipality you're in. But for example, one of the things that we like to do, something that's low hanging fruit, it is sometimes easier and cheaper for the same lender that does the development to also do the pre-development. So they'll do the acquisition of the land, some soft costs, and then it'll roll into construction once you're ready to go. That'll
Got it.
save you on some frictional costs there. We also like if you're doing, let's say, a multifamily deal. If you do a bridge loan with a group that also does Fannie and Freddie, right? They will waive their exit fees if they also do the Fannie Freddie. If you're doing a commercial income producing asset with a debt fund and they have a CMBS platform and they can do the CMBS on the takeout, they will waive
Got it.
the exit fee. So there are some ways to cut it, but as I like to say, it's like there's death by paper cuts, but a couple of fees isn't what sort of sinks the deal, and that's not really where the pain is. It's in the structure, it's in the accruals, it's in the over leveraging is generally where we see a lot of the pain come in. It's
Right.
not because somebody paid an extra point, certainly not to us.
No, no, I get it. I mean, like, think of the value, right? So, like, one thing that I learned is that I could take an existing loan and just modify it, even and assign it to another bank, right? And I've seen that happen because a bank is willing to take on something and add to that loan. So, for a way for me to save doc stamps and closing costs is
Yeah.
just if my lender is friendly here, and now I'm moving to another lender, right, at a larger capital amount or something like that, they assign it as long as they're too friendly.
Correct.
But on the other, right, every $10,000 you overspend on insurance could be costing you over $180,000 in property value at a 5.5 cap. This isn't just about savings, it's about equity. Look down in the description below. You'll find a link. Click it and see how much hidden value is locked inside your current policies. We'll break it down for you. Fast, clear, strategic. And you will be referring us out in the future. So, okay. So we're going to wrap this up with David's future outlook because obviously everybody asks, what's going on with the capital markets? Where are they heading over 6-12 months? What's going to change? Are interest rates going down? What risks should sponsors be pricing in now that they may be ignoring, right? And where is the opportunity for most investors, that they're missing right now?
And so I'll break it up into sort of exogenous and then at the local level, right? So there are certain things that we cannot control, right? I cannot control interest rates. I cannot control tariffs. I cannot control wars. And so, do those things affect me? Sort of, right? Depending on where I borrow from. If I'm borrowing from capital market lenders, CMBS, CLO, CDO, technically Freddie, they're very much susceptible to those shocks to the system, right? And so if you're going through a financing process and something happens, you're going to get whacked. And if you have floating rate debt, if something should happen and something spikes, you're going to get whacked. So if you're worried about all that noise, fixed rate and more balance sheet oriented lenders. If you look at the yield curve, all right, so the yield curve is a function of short-term rates versus long-term rates. We've been in an inverted yield curve for a couple of years. Ironically, when you're in an inverted yield curve, it usually means you're heading into a recession. And
Right.
there's certainly been a lot of argument if we've been in technical recession or not. I would argue we have, but frankly, I worry more about stagflation than I do about recession. But all that economic mumbo jumbo doesn't sort of mean much to most of the real estate guys. So it's just a function of, what are you worried about? You worried about tariffs? Fine, lock in your pricing with your GCs earlier rather than later, right? You're worried about shocks to the system with interest rates and potential spikes in rates as the long-term rates. Like recently, the Treasury auction was actually quite scary, right? Because it was the lowest. I forgot since when, but I wish I had
Demand.
I wish I had a chance to you're testing my
Show
memory there.
charts.
But
Right.
it was the lowest show of foreign buyers for Treasury. It was all local guys, right? And so that increased the cost of borrowing. When that increases the cost of borrowing, it sucks money out of the fixed income, which increases costs for everybody. And so if you're worried about that, you want to lock in today and not play the interest rate game of maybe rates will drop or maybe they'll go down. From a pure real estate standpoint, where we're seeing some interesting plays is emerging asset classes like IOS, right? Industrial outdoor storage has been pretty hot. BFR, built for rent, has been pretty interesting as well. We've had a lot of demand, probably more than we've had ever in the life of our company, for lot development deals. So the home builders, homes are still selling like crazy. It's actually been quite interesting to see. If you look at the public home builders, they're running out of land and they don't want to do land banking, and the housing market is still going for the entry market, right? And it seems like it's fairly resilient. And so they all need sites. So if you're out there buying land and then going through entitlement process, I think that's a pretty good play still, especially if you can mitigate risk with contracts or forward sales to the land builders. I also think, if you want to be a little bit more enterprising, a good contrarian play, office. Um, you know, like, we bought this. I'm sitting in my office condo. I wish I had more money to buy more. Probably a generational opportunity today to buy well-located office at well below replacement cost. We can make the argument of back to the office versus work from home, but eventually things will revert back to the golden mean, and that is my belief that people are social animals. They want to be in the office space.
100%.
So we're even from my own principal stuff. I'm looking more at office than I am at multifamily.
Right. We call that when we buy below replacement cost value, you can't replace the asset, right? We call it buying by the pound.
Yep.
Right.
It's all by the pound.
And right. This is what most investors miss. Structure is the silent killer or the secret weapon. David Eisenberg doesn't just help people close deals. He helps them survive the cycle and scale. And at Premier Protection, we're proud to stand next to him as a risk strategy partner. So if you're sitting on a portfolio, let's make sure, number one, it's protected. And number two, if you're facing capital stack issues, submit your deal to David at his website, david@eisenberg.com, and so forth. But make sure you subscribe to this channel, hit like, share this with your partners, your sponsors, everybody. This is Real Estate Profit Boost. We'll see you on the next episode.